Your house burns down. For years, you did the responsible thing. You paid the premium. You insured the home for what it would cost to rebuild, and you assumed that meant the company would rebuild it. Then, the check arrives, and it is for less than half. Not because you were underinsured, because of two words printed in your policy that you never noticed: actual cash value. Those words just turned your full coverage into a depreciated fraction of it. And the day to discover the difference is not the day after the fire. It is right now. Every homeowner's policy pays a claim one of two ways, and the difference can be a rebuilt home versus a bulldozed lot. The first is replacement cost. The second is actual cash value. They sound similar. They are not. One pays what it costs today to put your home back. The other pays that amount and then subtracts for age and wear before it ever reaches you. Same fire, same house, same coverage limit, wildly different checks, depending only on which phrase governs your policy. Start with replacement cost, because that is what most people think they bought. It pays what it takes to rebuild with materials of like kind and quality at today's prices, with no deduction for the age of the house. A 20-year-old roof destroyed in a storm is replaced with a new roof, and the insurer eats the difference. This is the coverage you want. It treats your home as something to be made whole, not appraised for its used value. Now, actual cash value, and here is exactly how it shrinks your check. Actual cash value starts with replacement cost and then subtracts depreciation. Depreciation is the value lost to age and wear. Take that 20-year-old roof. Replacement cost is, say, $20,000. But the roof was 2/3 through its life. So the insurer deducts roughly 2/3 for depreciation and pays you closer to $7,000. The roof still costs $20,000 to replace. You are handed $7,000. The gap, $13,000, comes out of your pocket. That is the entire mechanism. Replacement cost minus age. Now scale that single roof up to a whole house. Every component depreciates. The framing, the wiring, the plumbing, the cabinets, the flooring, all of it aged and discounted line by line. On an older home, total depreciation can erase half the replacement value or more before the first dollar reaches you. After a wildfire or hurricane, families with actual cash value policies have received checks covering a fraction of rebuilding cost, depreciated. To the studs. So why would anyone carry actual cash value coverage? Usually for one reason: it is cheaper. The premium is lower, and at the point of sale, lower is what gets bought. A family shopping for the cheapest acceptable policy may be steered into it without understanding the trade. They are not buying less coverage on paper. The limit looks the same. They are buying a settlement method that quietly discounts every claim. The savings are visible every month. The cost is invisible until the day the house is already gone. There is a partial protection built into some replacement cost policies, and it has its own trap. Many pay in two stages. First, they send you the actual cash value, the depreciated amount, as an initial check. Then they hold back the rest, the recoverable depreciation, and release it only after you rebuild and submit the receipts. So even a replacement cost policy hands you the smaller number first. If you cannot afford to rebuild on that partial check, you may never trigger the rest. The full coverage exists, but only for those who confront the gap. Stack these together, and you see why so many insured families end up underwater after a total loss. Actual cash value silently discounts the claim. Recoverable depreciation withholds part of even a good policy until you prove you rebuilt. And on top sits the coverage limit, often set years ago and never updated for the rising cost of construction. 3 separate gaps, any one of which can leave a fully insured homeowner tens of thousands short. The premiums were paid. The math still did not add up to a house. So here is what to do today while nothing is on fire. Pull out your declarations page, the one-page summary at the front of your policy, and find how your dwelling coverage is valued. Look for the words replacement cost or actual cash value. If it says actual cash value, or if the roof is carved out for it while the rest is replacement cost, you have found your exposure. Call your agent and ask what it costs to convert to full replacement cost. The premium difference is usually small. The claim difference can be your entire home. Second, check the coverage limit itself and ask about extended or guaranteed replacement cost. Construction costs have climbed sharply, and a limit set 5 years ago may not rebuild your home today, even with replacement cost valuation. Extended replacement cost adds a cushion above your limit, often 25 or 50%. After a regional disaster, when every contractor is booked and prices spike, that cushion is what stands between you and a permanent shortfall. Third, document your home before you ever need to. Walk through with your phone and film every room, every appliance, every upgrade, and save receipts for major improvements. After a fire, the burden is on you to prove what you had, and depreciation arguments are won or lost on evidence. A homeowner who can show a documented new kitchen fights depreciation far better than one relying on the adjuster's memory of ash. The footage costs 20 minutes today. It can be worth tens of thousands on the worst day of your life. Nobody reads the valuation method when they buy a policy. The price is on the first page, the limit is on the first page, and those feel like the whole story. The two words that actually decide whether you rebuild are buried where almost no one looks, and the cheaper policy hides them best. The question your policy already answered, in language you never read, is whether it insured the house you have or only the depreciated shadow of it. Find out before the fire. If this changed how you read your policy, episode 33, the roof depreciation schedule, follows the same logic into your attic. It shows exactly how a 12-year-old roof gets valued down to pennies. It is on this channel.